I probably should stop this.
Welcome to...
Hey, everybody. This is Russ Porter from John L. Scott Real Estate.
And Brandon Christensen with Dwell Mortgage.
Hey, so welcome.
Thanks, Russ.
Good to see you back here again.
It's good to be back.
This is what our second attempt at a podcast.
That's the perfect choice of words, attempt. Yeah.
I think we did pretty good on the first one. So.
Yeah. So it might be safe to say, Russ, that this is going to be our second execution.
Yeah?
Yeah.
Because we pretty much...
You know what Yoda says about trying.
There's no try, there's only do.
Exactly. So we're just going to do a podcast.
All right. Let's be Yoda.
Let's do this.
All right. So, let's just jump into things here. Yeah. So, how's everything going?
It's going pretty well, Russ. There's been, on the personal side of things, there's been some changes.
There's some news right there, huh?
Yeah. So, my wife and I had a baby back in August of 2022. He's now 6 months old. He was our fourth child.
All right.
So we have a 14-year-old, 9-year-old, 4-year-old, and then the baby. And
that's a full house right there.
Yeah, it is.
Right.
It keeps you guessing.
And a dog, right?
Well, no, the dog didn't make the trip.
Oh.
Yeah.
All right.
Yeah, that's another story for another podcast.
I guess so, right?
But not necessarily a fun story to talk about on a Monday.
Sorry I brought that up.
No, it's okay. Well, I'll tell you guys, I mean, I don't want to leave anybody guessing at home. We were getting ready to have the baby. I mean, this is a good segue, Russ. We were getting ready to have Calvin. And Annie, our golden doodle, started just using the restroom all over the house. And we tried for months to try and break her of the habit. And we just got to the point where it wasn't getting better. And we're preparing for a new baby, and so it just got to be a little overwhelming and too much. And so luckily, we loved Annie, don't get me wrong, but we found a guy that is going to love her even more and has turned out to love her even more. He works for Google downtown Seattle, and he gets to take her to work. She rides in a little backpack on his back. He scoots into work.
Yeah.
And so I think she's in heaven. And with 4 kids, it was going to become increasingly challenging to be able to kind of give her the attention that she deserved. And so it all worked out for the better. Fast forward to August, Calvin was born. And right around the holidays, Russ, we got a phone call. Ashley got a phone call from her mom about a baby that needed assistance. Mm-hmm. And she was struggling, not a great situation that she was born into. But, the gist of the story is we had the opportunity to be foster parents for her and provide her a home to live in. And ultimately with the goal of making her, an official member of the family at some point once you go through their processes and stuff. And so right now, Claire is 4 months old. Well, yeah, because Calvin's 6 months old. Yeah. So Claire's 3 months old. So we have
2 babies.
We have a 6 month old.
That's easy, right?
You can tell by the memory is kind of just foggy. Like there's just 2 babies.
Yeah.
That's how I look at it. Like it's almost like having twins, but it's not like having twins. It's different.
Because they're in different stages. So
they are in different stages, yeah. And so it's been a uniquely challenging but fun and just like lovely time in our household. Like to see the other kids kind of warm up to the baby that nobody was really expecting. Like it wasn't planned, obviously. Sure. And my wife Ashley has been an all-star through the whole process. Like she's a super mom. So she's the real magic behind everything that goes on in our home. So I'm just here with you today, Russ, to record some content, do some education, and hopefully impact anybody who listens to this, their life better in a positive way, and help them out with whatever they need help with. So
just in that short little story there, I mean, everybody kind of came out better for what their situation was. Annie's in a great situation.
She is, yeah. She is.
Claire's now in a better situation. So everybody's got a loving family to take care of them.
Right. It's
everything works out the way it's supposed to. Right?
It is, yeah. And Ashley and I are firm believers that that's exactly true. That like there's a definite like reason why things happen and a plan, and we're just trying to do the best that we can in the situation and help and serve and love and do those things, and whatever you want to call it, karma, whatever. Like we just hope that we can make a positive impact wherever we're at. So that's what we're doing.
Awesome.
Yeah.
Good for you guys.
Thank you. I'll have to share some pictures
Absolutely.
And you guys can see what's going on at the Christensen house. It's not all rainbows and unicorns anymore. Yeah. There are a lot of unicorns. My 4-year-old's obsessed with unicorns.
Is that right?
So yeah. Liv's a big unicorn fan, and Jack's a free spirit. Jack's the middle child, was the middle child until Calvin was born, and then Bennett's the older. We're going through that teenage phase, Russ, and you can probably shed some light on this for me. How do you do it?
I have 3 of them right now.
Yeah.
So
we're just kind of getting our feet wet, and it's scary.
That it is.
Yeah. So, I mean, he's still like Bennett. Bennett I knew before he started hitting that phase is still in there. I can see him from time to time.
Right.
Comes out. But then there's like random
a hug or something like that.
But then there's like random like emotional explosions and like, you know what I'm talking about, right? Those hormones get firing, and he can't explain. He can't explain how he feels, and you know, certain things aren't cool anymore, and you know. But he's a big sports guy, so we connect on that. We watched the Super Bowl together, and he's a big Mahomes fan.
Is he?
Yeah, he just jumped on the Mahomes. I don't want to call it the Mahomes bandwagon because he's kind of been there since the beginning. Which really, since the beginning, Mahomes been really good. So
that was a pretty good game. I mean,
it was a good Super Bowl, wasn't it?
From start to finish, I think.
Yeah. He was on pins and needles because it felt like that first half, the Eagles were they were going to have the edge.
Right.
You know? But kudos.
And Mahomes got hurt.
He got hurt.
He never knew he was going to be able to come back.
Oh, yeah, the face he was making after and it didn't even look that bad, but when you have an ankle injury, I've been there. And you have too, right? Knees, awful. Ankles, yeah. Anytime you're like rehabbing from that and you're still playing or trying to play, and then like the slightest tackle or twist or, you know, misstep, it just is excruciating. And so props to that guy for sticking it out. I don't know. Do you know what a whoop strap is?
A whoop strap.
You ever heard of that?
No, I don't.
So it's one of those wearable technologies. This is not an advertisement, and we're not endorsed by Whoop Strap. Whoop, by the way.
Maybe we will be, though.
Yeah, but anyways, it's I had one for a while, but it malfunctioned, so I'm waiting for a replacement. Oh, yeah. And it's one of those wearables that you wear like a smartwatch. It doesn't have a face or any time or anything on it. All it does is kind of record 3 different aspects of your life. It recovers how much like you output, your strain is what they call it. How much you recover, which there's a lot of components to that, like dietary and sleep and stuff, and it also like tracks your heart rate and your blood oxygen, all the things that the typical wearables do. Anyways, the reason why I'm bringing that up and why this relates to Patrick Mahomes is because he's been an endorser. He's whatever the word. He's been on the advertisements since the beginning of Whoop, and they posted his like stats from the Super Bowl.
Oh, really?
Yeah, which was interesting. And they have a scale from like 0 to 21 when they measure strain. And they basically said that 21 is impossible to achieve, like with their algorithm. Yeah. Like you can get close to 21 on a strain day, but you really got to be under some pressure. Mm-hmm. Like I think they said, like if you did an Ironman, you'd be pushing 21. Right. And then anybody who knows anything or has done an Ironman knows that that's a physically straining activity to do. And it measures, it's got all the different things in there that tells it, you know, it's not just your physical like heart rate. It's they're doing all sorts of calculations on, you know, how much sleep you had the night before and like what your diet and how that's impacting your what do they call it? Heart rate variability. HRV is a big measurement that they use. Anyways, they posted Mahomes, his data from the Super Bowl. And I was thinking about this because I watched him play, and he wasn't out there that much.
Yeah, they were not on the field for good portion.
Time of possession, like the Eagles pretty much dominated, certainly in the first half, and like he wasn't out on. And they had that defensive touchdown, right, that they called back and all that.
Right.
Or did they have another? They had another defensive touchdown too.
They did have a defensive touchdown.
They almost had 2. Yeah. So like he wasn't out there for a good portion of the game, and his strain that they posted on the social media channels was 20.7.
20.7.
So being
out of 21.
Out of 21. So being an NFL quarterback playing in the championship game, that's what it took for him to win.
Amazing.
Which is crazy, right?
Yeah.
I mean, if you look at him, he's out there for a couple of minutes in spurts typically, right? I mean, the longest drive is usually like 8 to 10 minutes. That's like super long, like
right.
And there's 30 to 45, 50-second breaks in between every play. So it's just interesting how like the physical, the mental, the emotional, all the psychological, everything works together when you're out there performing, right? So I thought that was interesting.
That is pretty cool.
Yeah.
Like that they can overcome so much to
Yeah.
be at that top level.
Yeah.
Right?
Yeah. And it was, there was a lot of cool storylines in that game. The Kelsey brothers and the mom. Did you see the mom with her
Saw the
split
mom with
jersey
her-
and
yeah.
split jacket? She had 2 different shoes on, Donna. And yeah, it was, those two are something else, the Kelsey brothers.
Yes,
yeah,
they
they got
definitely
some
have some
personalities.
personalities.
Yeah, for sure. I feel like Jason, the older one, is a little bit more mature in how he presents himself. But I think they're both kind of a little wild. I get that impression. They're Ohio boys, Russ. They're Midwestern boys. Yeah, those guys. They grew up in Cleveland.
Yeah.
And they're a little bit. Jason's older than I am. Travis is younger than I am. But I still, growing up in Detroit, I remember hearing about them.
Is that right?
Yeah. I mean, because that's right around the lake, right, from Detroit. You go to Cleveland's probably 2 hours, just on the other side of underneath Lake Erie there. So, yeah, I remember hearing about them because my family has ties to Ohio, too. My mom and her siblings and family grew up in Ohio. So we would go down there and visit. My uncle played ended up playing professional baseball, but he was a big high school baseball player down there.
Right.
And so I remember hearing about those guys. And it's just interesting to see them both in the NFL, not just in the NFL, but like both of them performing at the highest level possible in their role. Because basically, like, he's the number 1 tight end, Travis is, and Jason's the number 1 center, right? It's just like from the same family, from Cleveland, Ohio, at the same time, in the same Super Bowl. It's just crazy. I love that kind of stuff. Yeah. It's inspiring. Yeah.
For sure.
Anyways.
All right.
You can get me off on a sports tangent anytime you want, Russ.
Why don't we go into a little bit of, I guess this is all about Brandon today, because Brandon's got a lot to talk about.
I seem to be a talker, although my wife would accuse me of not talking enough and sharing my emotions.
Is that right?
With her, yeah. You got to open up more.
That's right.
You got to get me on a podcast with Russ. I'm wide open.
That's what you need, right?
Yeah, I'm wide open. Right. I mean, you even got me to wear a pink shirt. I mean, we've been talking for a few minutes now. The people are wondering, what are we doing wearing these pink shirts? If we're talking about sports, what is this, Russ? NGSSA.
So this is actually a local organization that I belong to. I'm the president of the North Shore Girls Slow Pitch Softball Association.
The Press?
The Press, yeah.
Nice.
So we're a recreational league, and our focus is really on teaching the game to girls. We're not about the best athletes necessarily, although we do have some great athletes, but it's about the love of the game and having everybody get the opportunity to play and to enjoy the game and to learn it and to be part of a team. Those are the type of the aspects that we're looking for in promoting our league. We're not there to say that we have the best athletes and we're going to send your kid to college and things like that.
Yeah.
But we want to make sure that they have fun and they grow and they learn and they're active. And
you guys have teams all over?
Most of our teams are within the North Shore School District.
Okay.
So Bothell, Woodinville, Kenmore.
Yeah.
But we do since we're a rec league, we kind of make our own rules up as to who's allowed to be part of the league. So we have people from all over the area that come to play in our league.
It's a great organization. I've been around it, in a limited capacity a couple of times at some different events and tournaments, and it's a great thing that you're doing, Russ. I really enjoy being out there, seeing all the girls, having a good time. We did a barbecue or something last year
for our
at the
tournament, our mid-season tournament.
Yeah, and
that was incredible for
you
to come out there and do that with Goosehead Insurance.
Yeah, right.
You guys are there all day barbecuing and
hot dogs and hamburgers, and huge. I remember as a kid playing rec sports, right? I remember doing those weekend tournaments, baseball tournaments. There's nothing like grabbing a burger after the game. Because you're always, you're playing back to back or whatever on those tournament days, right? You got a couple games, and there's nothing like the in between where the coach is like, all right, guys, we got 40 minutes. Go get a burger. Right. And you're like, you feel like a king when you're a kid, grabbing a free burger and some chips, and there's a soda and a water or whatever.
You sit down with your friends.
Exactly. Have a little picnic. The weather, you never know in Washington, right? But
you never know.
Sometimes
we've had 80, 85 degrees. Sometimes it's been 40. So
rain or shine, it's always a great
usually,
event.
First weekend of May that we have our tournament.
So yeah, be on the lookout for that. And I think, are you guys looking for like people to, if they're interested, being involved in any capacity, or?
I mean, we're always looking for volunteers and sponsors.
Okay.
I know you've sponsored in the past and just last year, and it's been great. So, we're looking to do some more fun things this year for our tournament. We're going to have a dunk booth, so we're going to
dunk the president.
Kids are going to be able to dunk the coaches,
Nice.
the presidents, anybody that's involved in the league. Maybe some umpires will get involved in it. So it'll be a little bit of a fundraiser for the league.
I'd pay money to dunk an umpire.
For sure.
That's worth it. I tended to like my coaches, but the umpires, let's get them.
And hopefully we'll have the barbecue again this year and some ice cream for the girls. So it's going to be a fun mid-season tournament. It's usually it's a long weekend, so it's nice to have some fun things that go along with it, other than just softball. To break it up a little bit.
You know,
really enjoy it.
That reminds me of a story. Do we have time for a story?
We always have time for stories.
So when I was a kid, I must have been 8. Yeah, probably right around 8 years old, for Christmas one year. This might bring some people back. You know, the toys back then were just better, in my opinion. I don't know why. Like, it wasn't just video games. Now it feels like it's just always just video games. But there was this toy that I wanted really, really, really bad, and it was called Nolan Ryan Strike Zone Baseball. Have you ever heard of that?
No, I don't think I have, actually.
Yeah, so, I mean, if you have, you're probably shedding a tear right now. So it was
I wish I still had it.
I do, and you can find them on eBay, but I don't know if they even work anymore. But it was this thing that hung on the back of your bedroom door.
Right.
It had like straps that would hook onto the door. There was 4 straps. And then it was basically like a strike zone. And then there was a batter and an umpire and a catcher, like behind the strike zone, right? And there was these little like foam balls. And then it came with like the, you know, the bases and the pitching mound and stuff. And you'd basically play an electronic game of baseball as if you were Nolan Ryan, throwing the balls at the thing on the back of the door, trying to land it in certain quadrants of the strike zone.
Right.
And then you'd either get the guy out, strike him out, you'd walk him if you kept missing, or you'd get a hit. And it was like this interactive baseball game.
That's pretty cool.
Nolan Ryan Strike Zone Baseball, right? So there were like little sounds that the game would make, and one of them, somebody in like the audience, because it had like the crowd sounds, somebody in the audience would yell, "Kill the ump." So the reason why I'm bringing this up is because I played that game so much that it got on my parents' nerves. Like they would, you know, just the sounds over and over and over again. It's you remember those old games that there was like 10 different things.
Oh, yeah. Like Tecmo and things like that.
The guys, they weren't programmed to say more than 10 different phrases, right? So "Kill the ump" would come up quite frequently. And my parents were both very supportive of me playing sports when I was a kid, but my mom was there more for the social aspect of it. She never really like learned the rules of the games that we played, so she never really knew what was going on. She was just there to support us and cheer us on, right?
Yeah.
And so one time, I think I was in high school at this point. No, it was before high school, middle school baseball. And I'm up to bat, and I get a pitch, and I don't swing at it because I'm clearly on the side of that's a ball to me.
Right.
Like, I'm not going to swing at a ball. And the umpire calls it a strike, right? So what does my mom say? What do you think she says, right?
She says, "Kill the ump."
She yells, "Kill the ump." Without even thinking. And she's just heard it so many times from this game that I played.
Yeah.
And the umpire turns around and gets real stern with her and issues a formal warning to her and says if she says that again, she's out of the game. And anyways, my mom, she was mortified, and she was like, it just kind of came as second nature because she had heard it so many times. And like I said, she was never really locked into the game. She was probably talking to Nancy next to her, and they were talking about the bake sale or something. And then she saw that play and just yelled, "Kill the ump," naturally. And so my brothers and I always give her a hard time about that. But anyways, that's, that "kill the ump" experience would still today cause me to really want to dunk an umpire.
Yeah.
Yeah. If I have an opportunity. So keep us updated, Russ. If we do get a dunk take out there,
all right,
and we can dunk some umpires.
First weekend of May, North Shore Sports Fields. We're going to be dunking umps.
All right, let's do it.
All right.
Cool. Anyways, well, there you go. There you have it.
All right.
What else you got, Russ? You got anything?
All right, well, let's talk about the market. What's going on with the market? You guys have lots of changes over at Dwell Mortgage, so let's talk a little bit about what's going on with Dwell and all the changes that you guys have been
Yeah.
with now?
We've talked maybe a little bit about this, but I've been in the lending business in one form or another, either residential or commercial lending, for really the last 12 years. If I did the math, it's probably 12 to 15 years. And residential lending, which is different than commercial lending. Commercial lending is, buying and purchasing businesses, business real estate, strip malls, large apartment complexes. Residential lending is more focused on like that single family space, 1 to 4 units. A fourplex would kind of be the max that you would see in a residential lending space. And so I've been around quite a bit. I've seen a lot of different things. There's a lot that goes on in the mortgage process and behind the scenes that like a client or somebody buying a house doesn't really even care to know. But we just identified over the last 2 years, we identified some things that we really wanted to improve upon, or offerings that we wanted to be able to deliver to our partners and our clients that just weren't readily available in some of the other lending spaces that exist out there. Right. There's retail lending, there's brokers, there's correspondent lending, there's a lot of different types of lending. And so what we decided, kind of after experiencing the really, really low interest rates, right? Remember that? Everybody is refinancing 1, 2, 3 times. Every time the rates dropped, another refinance again, over and over and over again. And then the rates went up, right? And that was kind of a big stab in a lot of people's guts, because it made buying a house slightly more challenging. Affordability became an issue. And so we were looking at things going, knowing what we know about lending in general, like what can we do as a local company based out of Everett, Washington, to be able to provide the most competitive interest rates to our clients, while at the same time being able to deliver an experience to them that was superior in all ways. Now, there used to be a saying that you can never have something that is both cheap, fast, and works. You ever heard of that?
Yep.
Like if you think about it, look at it like a Lamborghini, for example. Is a Lamborghini cheap?
Not cheap.
Not cheap at all. But does it work?
Sometimes.
I mean,
most of the time, I would think it would work.
If you're going to pay $500,000 for a car,
you hope it's not going to be in the shop half the time.
Yeah, right. And it works and it's fast, right?
It's really fast.
But like in life, there's a lot of times where you feel like you can't get that trifecta, where it's inexpensive, it works really well, and it happens really quickly. Because normally you're paying for convenience, right?
Right.
Typically, if you have to pay for speed, then it becomes more expensive. And so our whole focus was to develop a solution for our clients where we could deliver on that trifecta, where we could be ultra competitive in our interest rates, have a really, really good process that works really well, and it works really fast.
Right.
So that's the goal. You're getting more leads, Russ. I can hear it. Yeah. Russ he's the guy. I mean, he's dominant in the real estate space. People are calling him all the time, trying to get
off
him
the hook.
Yeah.
Right?
You got to get a person that just answers your phone.
I think I might need to do
personal
that, right?
assistant, right? So that was the goal moving into 2023, and it became even more important to try and deliver this to the market as soon as possible when rates went up really high, because now, rightfully so, everybody's really sensitive about interest rate pricing. It makes a difference, right?
Makes a big difference.
Makes a huge difference. We went from like 2-3% to 7-8% in a matter of months. And that caused a lot of people to hit the pause button because payments went up so fast that they were like, can I do this? Can I afford this? And so we wanted to really make sure that we had our foot on the gas pedal when it came to being able to deliver the best possible interest rates to our clients. And so that's what we did. We started our own private mortgage brokerage. So what that really means is we eliminated all those like layers of like, think a big company, like how many layers of people are there?
Way too many.
Yeah, and that's what you'll see with a lot of large mortgage companies is you've got layers of leadership, and when you have layers of leadership and people that are involved in the process, it becomes very expensive and it becomes much slower.
Right.
Now, that's not true for every organization. Some organizations that are big have perfected efficiency, but that doesn't mean that they're cheap or affordable. And so our goal was to kind of remove all of that and be able to deliver all of this to our clients at the local level, so that they could get the best interest rate pricing with still an amazing experience and amazing speed. And so that's what we've rolled out. We officially launched the new brand and the new company that first week of January.
Right.
So we're just over a month into that, and we're learning a lot. We're having a really fun time. It feels like to me that the market's kind of picked up a little bit.
That certainly has, yeah.
Right? And you could probably shed some light on that, Russ.
Yeah, we'll just go over a few stats that try to keep an eye on how things are going on a macro level and a micro level. So, as far as Washington State, we've kind of we took a pause button for probably December and the early part of January.
Maybe even November was in there too.
A little bit in November, yeah. I think things were kind of moving as far as what the inventory was out there. Things were getting snatched up at a better price because they were on the market for a little bit longer. People had the ability to get some concessions from sellers to make things a little bit easier for them to afford the higher interest rates. So, but now that we're in mid-January, early February, we've kind of seen a little bit of a shift again. We're starting to get into that spring market where
feels good.
Things start to pick up a little bit. The interest rates have kind of settled a little bit.
Yeah.
I think they've spiked in the last couple of weeks, but overall they're down from where they were. And
they really peaked in October, which is kind of why you saw that
7.5%, 8%.
Yeah, in a lot of scenarios for sure. Which is why, to your point, why we saw November, December, January be kind of slower because rates were at their peak. And yeah, they've definitely come down from their highs, but they're moving up and down. It's all, we can talk about that, Russ. We can talk about the why behind that, but like nothing ever moves in a straight line when it comes to markets. It's ups and downs. And so currently we're seeing rates go up a little bit, but not like they were back in October. So it's not something to be
a lot of that's just kind of speculation on what
there's a ton of speculation out there right now.
Everything's always speculation.
It's always, right? It's always, what's
Powell going to do next? And
there's some concerns about the budget, right? The U.S. budget and kind of
whether or not inflation is under control yet. People think that it's kind of settled down over the last couple of weeks, but now it's starting to. We just got numbers today that said it was a little bit higher than what they were hoping. So.
That's true. Well, let's be clear on that. This is important. So inflation is lowering.
It's lowering.
But not as much as they expected.
Correct.
Which is what caused, like anytime something happens in the market that is not what was expected, there's going to be a reaction.
Right. Because everything's sort of built in for what they expected to
be. Good or bad. Like inflation, if we thought like inflation was going to come in higher and then it came in lower, we'd see a positive reaction when it comes to mortgage rates. The fact that the numbers that came out today were still better than they were last month, but not as good as they thought they were going to be, has caused the market to react negatively to that news. Even though inflation is still declining, which is what we want, which is what all this hullabaloo for the last 6 months has been all about, but it wasn't in line with expectations. And so there's a slight negative reaction, but we're on a trajectory right now with a downward trend in interest rates.
Right.
So we're still in that window, Russ. I think, we're still in that. I talked about a window. If you guys follow me on social media, I had a little video about the window of opportunity. Even though rates are higher, there is still some negotiation. There's that window where you can still kind of negotiate, right?
A little bit.
Some opportunities to get some concessions if you need it. Depends on the neighborhood and on the market and stuff. But I feel like the window's closing.
Yeah, so we've already seen our adjustment for the majority of it. The prices have come down. They started off really high last year, and then they came down to basically where the level was at the beginning of the year. So we're kind of seeing that adjustment already baked into everything. So we're not seeing a lot of price adjustments so much as we were. But things are kind of picking up because there's a lot more buyers coming out back into the market now. Now that their expectations have been set, that they know what the interest rates are going to be. There's a little bit of a up and down with the interest rates, but for the most part, they've kind of leveled off to where they're they know what to expect over the short term at least.
I love this time of year, Russ, because it's so many little factors working together to kind of, the markets are so interesting. There's all these little things happening that cause different movements in the market. And I think the reason why, you might have a different perspective or take on this, but I think the reason why the spring market is such an exciting market is because the weather starts to change and people are starting to think.
It's a psychological factor for sure.
Very psychological.
People are out more often. They see things, they're not hibernating in their house trying to avoid the rain.
And the other thing, like economically, is once you get over the hump of the new year and you go to work and you know you're going to have a job for the rest of 2023, because there's a lot of like uncertainty during the holidays. Have you ever noticed that?
Yeah.
Especially when you're in an economic downturn, which we are. Maybe call it a recession. Some people are calling it a recession. Some people aren't comfortable with that term yet. But anytime you're in that period economically, like there's some uncertainty in the winter. Am I going to have a job next year? Right? And so nobody's going to go into the home buying process with a doubt as to whether or not they're going to remain employed in the following year. But then that starts to kind of firm up in January and February. You go back to work, get back in the swing of things. I think employers have kind of figured out at this point, like their workforces and what they need to have for the fiscal year, for the new fiscal year, the new whatever year if they're working off the calendar or the fiscal year. I don't know. It just depends on the company. But like it starts to all kind of firm up. People get more confident in their jobs. Employers are more confident in their workforce. People are excited about the weather shift. Interest rates are down a little bit, right? Home prices have come down. They're stabilized. Like it's all those little things working together to cause that like tick up in market activity. Yeah. Interesting.
Makes sense for sure. So, yeah. What do we talk about next? That was a lot of information all at once, right? So
we're good for information, Russ.
Right.
We give people a lot of information. You want to talk about? We talked about changes in the real estate market. You want to talk about changes on the mortgage side?
Sure,
a little bit.
Yeah.
So, this is good news and bad news. Everything feels like it's a hybrid nowadays. Right. So you find the silver lining. There is a silver lining. So, the FHFA, Russ. FHFA.
Which stands for Fair Housing.
No.
No? Am I totally off? I should probably know this, shouldn't I?
The
FHFA.
Yeah. FHFA. Federal Housing Finance Agency.
Federal Housing Finance Agency.
So this is the government agency that is in charge of a lot of things, but they're primarily in charge of kind of regulating Fannie Mae and Freddie Mac.
Okay.
They're the ones that, like, when you hear the announcements about like loan limits changing,
conforming loan limits is
they kind of govern that space, and it's always more complicated than that because it's a government agency. But they're the ones that kind of dictate how mortgages happen, what's required, kind of what we're going to do moving forward. They help Fannie Mae and Freddie Mac kind of manage things, because Fannie Mae and Freddie Mac are technically non-governmental agencies. Right. But after the housing crash, because they were largely unregulated before the housing crash, which caused some problems.
A few problems,
challenges in the real estate market. And so the FHFA came in and said, well, we're going to put some checks and balances in place to keep everybody in line and on the same page so we don't have another 2008. So they do the things like I was saying, the conforming loan limits. But what they also do is they set the stage for interest rates, in a sense, on different types of loans. Let me explain what that means. So the market is going to say, hey, this is how expensive money is.
All right.
Okay, there's mortgage bond markets, MBS, securitized mortgage bonds that trade on a daily basis, that as they change in price and supply and demand shifts, their numbers change and then interest rates move up and down. That's an independent financial market that is primarily what drives interest rate pricing, okay, at the base or at the core. Now, there's also, depending on the different, qualifications of a borrower, the different property types, the different occupancy types, there's different things that change within an interest rate to either make it cheaper or more expensive. So think of it this way. If you want the best of the best of the best interest rate possible, right? You're typically, historically, you've been a borrower or a home buyer with a credit score of 740 or higher, buying a single-family home, occupying it as your primary residence. That's typically like the best interest rate you can get, right? And so the FHFA looks at every different scenario and goes, well, this scenario's got more risk than this scenario, so this scenario is now more expensive, right? And it makes sense. Like they've got a whole different objective to keep housing and lending viable, right? And so they've made an announcement. They made many announcements. Last year, you might remember this. Last year, they announced that they were going to take a look at investment properties and second homes, and they were going to make those a little bit more expensive compared to like a regular scenario that we just kind of outlined. And the reason why they do that is they go, well, there's way more risk in that type of a property, and there is. A non-owner occupied property has more risk for the lender. It just does. Okay, and then second homes, same thing. Like, it's not your primary home, it's your second home, so it has a little bit more risk than if it was a primary home. This year, they've gone a little bit deeper, both good and bad, like I was saying, Russ, and they've made some adjustments to what they call the loan level pricing.
Loan level pricing, okay.
If you hear the term LLPAs, I wouldn't expect any of you to ever hear that, but you might.
You never know.
I mean, if you're listening to the news or you're reading an article somewhere, they might reference that, so it's good to know what it is. It's at the loan level, we're going to make an adjustment to the interest rate based on these characteristics. So, for example, if you don't have a 740 credit score, let's say you have a 720 credit score, there's a tiny adjustment to the interest rate. It's a little bit more expensive.
More risky.
Lower credit scores, higher risk, right? Same thing with, like, if you're looking at a single-family home, stick-built in a neighborhood, Russ, or like a manufactured home.
Right.
Or a condominiums. Different types of properties have different levels of risk. So there are these tiny adjusters that get they get priced into that rate to make that rate a little bit more expensive. Okay? So they looked at the LLPAs and they revised them this year. And these revisions take effect May 1st, 2023.
2023.
So what that means for you, if you're out there thinking about buying a home or going through the process right now, if Fannie Mae and Freddie Mac, FHFA governs them, right? Fannie Mae and Freddie Mac are going to put these changes into practice May 1st, then what we're really going to see or need to know is that people buying houses in March and April are going to start to see these changes. You know why? Because if I start the home buying process in March, when am I going to close?
Probably 30, 60 days after.
Yeah, April. Let's call it April, right? So if these changes are scheduled to take place or become effective May 1st, I'm going to close on my house in April. Now that lender that gave me the money to buy my house has to turn around, package that loan up, and sell it to Fannie Mae or Freddie Mac. That process takes a couple of weeks, sometimes longer. So by the time that loan gets delivered to the agencies, Fannie Mae, Freddie Mac, those pricing changes are in effect. So that's why you'll start to see them probably next month. Okay? Yeah. So it's something to be aware of. And like I was saying, it's not all bad changes. There's some good changes too. They've changed the way they look at FICO scores. Instead of just saying, hey, once you get to 740, gravy. Now the bar that they've set is 780.
780.
Yeah, 780 is kind of the cream of the crop. You get to 780, you get the best pricing, right? But on the flip side of that, something that they did positively is they made it cheaper for people with lower FICO scores.
Okay.
So which is in line with their initiative. Their initiative is to provide fair housing and affordable housing to everyone possible. Right. And so they realize anytime you go through an economic challenge, which we were in a pandemic for 2 years, and then now we're in like a difficult economic circumstance. Here's a statistic that I read yesterday, Russ. You like me and my stats? Yeah. So I was reading an article it was on CNN. I can provide it too if you want to fact check me. But it was saying that 60% of people making $100,000 or more in the United States are living paycheck to paycheck. Think about that.
It's crazy, isn't it?
Six-figure income earners are living paycheck to paycheck 60% of the time. That's a lot. So they understand that, like, things are harder now. I mean, just what the Fed has been doing by raising the Fed funds rate makes things like credit card payments, line of credit payments, auto loan payments higher and more expensive. Right? So that's become more expensive. Rents have increased, right? Housing costs have increased. So if everything's increasing and wages have stayed pretty much the same, that's why we're seeing this challenge. People are living paycheck to paycheck more often. And so Fannie Mae and Freddie Mac looked at that and they go, well, we don't want to eliminate the opportunity for these people to buy houses. Because if we do what we have been doing, we say as soon as you are like a 680 or lower, your interest rate's astronomical.
Right.
Which
doesn't make sense.
There's no way. right? They're not going to be able to qualify for the house because the payment's going to be too high, and then the cost for that interest rate is going to be an extra $3,000 to $6,000 to $8,000 for home buyers that are already doing everything they can to come up with the minimum down payment. They don't have an extra $3,000 to $6,000 to $10,000 to spend on loan costs to get a lower interest rate. And if you can't negotiate with the seller as much as you could before, it's harder to get that covered. So they looked at it and said, well, we're going to actually make it a little bit better for lower FICO borrowers, which is good. So they've done that. So if you had borrowers or clients, or if you yourself had tried to qualify for a home in the last 2 or 3 years and you were like, dang it, my credit score is just not quite 740, can't really do it, the interest rate's a little bit too high, it's worth revisiting.
Right.
As soon as these changes start to get implemented. And then there's some other things. They got less aggressive on interest rates for investment properties. Here's an interesting one. Duplexes and like multifamily stuff, they made more affordable.
Is that right?
Yeah. Which is interesting. Right. So there's little changes going on there. So it's just something to be aware of. Like, I don't know really what I would tell you to do about it other than to understand that, like, get education.
Yeah. I think the biggest takeaway is that don't get discouraged, right?
Yeah.
Everybody, I think home ownership is available to everybody in the country. You just have to be educated on what's the best way to do that. And it might take a little bit longer for you to get your credit score to where it needs to be, but there are plenty of programs out there to help you along that way to make sure that you can have that dream of home ownership at some point.
So you get an at bat.
Right. But you got to start, right? You got to get in there, and you got to start working hard at your finances and making sure that all those things that could help you out are implemented as soon as possible before,
Both Fannie Mae and Freddie Mac, Russ, have initiatives geared towards helping home affordability.
Right.
And they're good programs. Fannie Mae has a program called, now I'm blanking on the name now that I'm trying to talk about it. Freddie Mac's is called Home Possible. Fannie Mae's is called Home Ready. Okay. Yeah. These are programs that are specifically designed not only for first-time home buyers, but also people that, are on the lower income scale. And when I say lower income in Western Washington, what do you think that means?
50, 60,000 a year.
Okay, so listen to this. So the rule of thumb, and I get into the weeds on everything, but like you guys get me talking, I don't know how to stop. So they measure things based off of something called the median income, the area's median income. Right. So like, what's the median income in this area, right? And then they have different like levels or tiers of that median income number that allows you to qualify for different types of programs. Home Ready and Home Possible will let you go to 80% of the area median income. People are turning the lights out on us. They want us out of here. Been here too long. Right. So back to what I was saying, like 80% of the area median income in most of Western Washington, especially like the Seattle, Bellevue, metropolitan areas, right, is almost $100,000.
$100,000.
That's 80% of the area's median income. It's like 99.9 something.
Right.
Okay. So if you're a first-time home buyer, and do you know how to define what a first-time home buyer is?
Someone that hasn't purchased a home in the last 5 years.
3 years.
3 years.
Yeah, 3 years. I knew you were onto it, Russ, but we've talked about that before. So if you haven't bought or owned a home in the last 3 years, you can be considered a first-time home buyer. So these programs, and if you're making, 6 figures, basically, which is what it is, right around that level, you can qualify for these affordability programs, which I think are just very, very important to be aware of moving into this shift with interest rate pricing that I was talking about.
Right.
Because here's the kicker. You ready for the kicker?
Bring it on.
All that stuff that we just talked about, like FICO and your rate's higher, and if you're buying a duplex or investment or blah, 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 all that stuff is null and void if you use one of these programs, these affordability programs. So they waive all of these LLPAs, loan level pricing adjustments, right, if it's a Home Ready or Home Possible loan, which is great. And the other part of those programs that I really, really enjoy is the mortgage insurance, because mortgage insurance is a pain point, right?
Right.
Nobody wants to pay for something that they don't feel like they need to pay for.
Exactly.
Right. Like,
it's just a tax.
And that's like, insurance in general feels like that most of the time. You're paying premiums every month, and then like when your house floods, it's like pulling teeth.
Right.
to get them to do
it's
it.
counterintuitive because
Yeah.
you have to pay the mortgage insurance because you might not be able to afford the mortgage, but it makes it harder for you to
Right.
afford the mortgage.
Yeah. Yeah. Mortgage insurance is an insurance policy, just like any other auto, medical, whatever. You're paying for something that's risky, right? You're really paying for the lender's protection that if you end up defaulting on your mortgage, there's an insurance policy on the home that pays out to the lender to make them whole. That's all it is. And the rule of thumb, for whatever reason, is as soon as you put less than 20% down, in most scenarios, there are a few programs where you don't need to pay mortgage insurance, but traditionally, under less than 20% down, you have to pay mortgage insurance. Home One and Home Ready and Home Possible, these programs that we're talking about from Fannie Mae and Freddie Mac, they have more affordable mortgage insurance options. So there's little caps in place on these loans that say like things can't be more expensive than this. It's a great product, and I think it's going to be a very, very important product moving forward.
Yeah.
So, and then there's other like ancillary programs that don't even have income limits that are still affordability programs that are worth looking into. So there's a ton of opportunities out there.
There is, and don't be discouraged because you don't have all the information. Talk to Brandon. Brandon is, as you can see, a wealth of knowledge, and then you have some incredible programs within Dwell that can help people out in all sorts of scenarios. So
yeah, I think it's
get
a fun
educated.
time. It's fun.
Yeah,
there's a lot of fun things happening right now, Russ.
Yeah, for sure. Well, I appreciate your time.
Well, I appreciate you, Russ.
I don't want to take up too much more of your time. This has been a great, valuable session with you as always, and really appreciate your time. And
well, I appreciate you. Can I say one last thing in closing?
Absolutely.
I want to. You know how they do? Like, I was just joking with somebody on the airplane about this yesterday. You remember the TV show 24?
Yeah.
Jack Bauer.
Kiefer Sutherland.
Yeah, Jack Bauer. Right.
Yeah.
That was a stressful show.
It was
so stressful. And then they had that, like, whenever they would go to commercial break, it felt like whenever somebody was about to die or a bomb was about to explode or the terrorists were about to like invade the White House, that little countdown would come up. You remember the noise that it made, the little countdowner?
Oh, yeah.
Little timer? Yeah. I was joking with somebody about that because Ashley and I watched that show religiously when we were in college. And sometimes after we got married, when she'd fall asleep, sometimes I'd just play the timer next to her ear just to see what would happen. And she would wake up in like a cold sweat because it's like you get instantly brought back into that that moment of anxiety, right?
Right.
So in an effort to kind of leave you with a clincher, because that to me was what the clincher was that little timer. At the end of the show, you're like, no, why is it over? Right. Got to watch the next one. Right. We want you guys to stay, tuned in and reaching out if you need anything with us. The next couple of dates to really be aware of for interest rate stuff is March 10th.
March 10th.
And then May, middle of May. Yeah. Cause those are going to be like the next kind of like rate announcements, the next Fed meetings. If we can make it to March and May, we should see some significant improvements in interest rates. So stay tuned for that.
Right. So Brandon and I are going to talk offline, and we're going to figure out a time, probably mid-March. We can talk about the first set of things that have come out.
Yeah, let's do it.
See how things are.
Yeah, we'll be right back here next month.
All right. Appreciate everybody. Sorry, Ashley, for having to put up with him all the time, but you're incredible. So
she doesn't watch my stuff. She gets enough of me. I told her if you want to see me really be expressive, tune in and hear me talk about FICO scores and loan level pricing adjustments and Federal Housing Finance Agency. She doesn't care.
Deep.
Yeah. She's got 2 babies to feed.
All right. Well, thanks again, Brandon.
Thank you.
See you guys next time.
See ya.